Chapter 11. Security Analysis for the Lay Investor. General Approach. The meticulous examination of financial instruments has matured into a formidable and heavily populated profession, boasting vast ranks of dedicated practitioners, extensive academic literature, and rigid codes of ethical conduct. In recent years, a subtle but vital distinction in nomenclature has emerged, expanding the traditional boundaries of security analysis, which strictly confines itself to the rigorous evaluation of individual stocks and bonds, into the broader, more comprehensive realm of financial analysis. This expanded discipline encompasses not only the surgical dissection of corporate balance sheets, but also the architecture of overarching portfolio policy and the sweeping interpretation of macroeconomic tides. The dedicated analyst operates as an investigative historian, a present-day auditor, and a cautious prophet. They dismantle the operational machinery of an enterprise, scrutinize its current financial fortifications, expose its hidden vulnerabilities, and attempt to calculate its future earning power. They execute exhaustive comparative studies between industrial rivals and, ultimately, deliver a definitive verdict regarding the absolute safety of a senior debt obligation or the inherent attractiveness of a common equity. In this arduous pursuit, the analyst deploys an arsenal of techniques, frequently and unapologetically modifying the official figures blessed by certified public accountants, always remaining fiercely vigilant for accounting nuances that obscure the true economic reality of the business. The most mathematically dependable and historically respected branch of this profession is dedicated to evaluating the impregnability of corporate bonds and investment-grade preferred stocks. The absolute overriding criterion for determining the safety of a senior obligation is the coverage ratio. The specific number of times the corporation's total fixed interest charges have been effortlessly absorbed by its available earnings over a prolonged historical period. While the precise thresholds of safety vary among institutional authorities, a set of stringent, unyielding minimums can be established for the conservative allocator. For a regulated public utility operating company, the historical earnings must cover the interest charges at least 4 times over before the extraction of income taxes. A railroad or retail enterprise demands a slightly thicker armor, requiring a 5 times coverage multiple. For heavy industrial corporations, where revenues are inherently vulnerable to violent cyclical swings, a formidable 7 times coverage of fixed charges is the mandatory minimum for absolute safety. These metrics can be alternatively calculated on an after-tax basis or subjected to a stress test measuring the coverage during the single poorest operating year of the preceding decade. When evaluating preferred equities, the exact same rigorous multiples are applied, but the fixed charges must be expanded to include the preferred dividend requirements, properly adjusted for their non-tax deductible status. These stringent earnings coverage tests are supplemented by a battery of secondary, vital assessments. The analyst must demand a minimum threshold of sheer physical and economic size, ensuring the enterprise possesses the massive scale necessary to weather severe economic droughts. Furthermore, the capital structure itself must provide an adequate shock absorber. This is measured by comparing the total market value of the junior common stock to the aggregate face value of the senior debt. This ratio reveals the size of the financial cushion protecting the bondholders, reflecting the broader market's confidence in the future viability of the enterprise. While the sheer liquidation value of the physical property was once considered the ultimate security for a bond, bitter historical experience has proven that if the earning power evaporates, the underlying assets rapidly lose the vast majority of their appraised worth. However, asset values retain a crucial secondary importance when evaluating public utilities, real estate holding companies, and financial trusts. The intelligent mind naturally questions the dependability of utilizing backward-looking historical data to guarantee safety in an inherently unpredictable future. The defense of this methodology rests entirely upon the brutal, unyielding ledger of financial history. Bonds and preferred equities that have successfully passed these stringent quantitative tests of historical coverage have, in the overwhelming majority of cases, flawlessly survived the darkest macroeconomic storms. This was spectacularly demonstrated during the catastrophic railroad bankruptcies of the 20th century. The sprawling transportation empires that collapsed into insolvency, ultimately culminating in the shocking implosion of the massive Penn Central system, had all exhibited chronic, glaring deficiencies in their fixed charge coverage ratios for years preceding their ultimate ruin. A rigorous application of these elementary safety standards would have decisively warned the prudent allocator to abandon those securities long before the final collapse. Conversely, the heavily regulated public utility sector, fortified by sound capital structures and legally mandated rates of return, has rendered the specter of bankruptcy virtually obsolete. The industrial sector, however, presents a shifting, increasingly hazardous landscape. While historically demonstrating superior growth, industrial corporations possess a dangerous susceptibility to sudden economic contractions. The recent explosive appetite for debt-funded corporate expansion has dangerously burdened the balance sheets of many once impregnable manufacturers, demanding that the analyst remain hyper-vigilant and utterly refuse to relax their standards of safety simply because recent economic weather has been unusually calm. The transition from the predictable arithmetic of bond safety to the valuation of common equities introduces a profound layer of complexity and speculation. The supreme objective of common stock analysis is to derive a concrete, intrinsic value for the business, which can then be directly compared against the prevailing market quotation to determine if a margin of safety exists. The standardized procedure for this appraisal involves forecasting future sales volume, projecting pricing power and operating margins, and thereby estimating the average future earning power of the enterprise. This projected earnings figure is then multiplied by a specific capitalization rate to arrive at a final valuation. However, the sheer fallibility of human foresight renders this process highly precarious. A review of elaborate multi-year earnings projections formulated by prestigious advisory services frequently reveals a stark disconnect between the confident forecasts and the actual, realized corporate results. While the aggregated estimates for a vast index of companies often prove reasonably accurate, the projections for specific individual corporations routinely miss the mark by staggering, embarrassing margins. This inherent unreliability of individual corporate forecasting serves as the ultimate pragmatic validation for the absolute necessity of broad portfolio diversification. The capitalization rate, the specific multiplier applied to those future earnings, acts as an incredibly elastic, highly subjective variable that dictates the final appraisal. Two distinct corporations, both reliably projected to earn identical profits in the coming decade, might be assigned wildly divergent multipliers by the analytical community, resulting in one enterprise being valued at more than double the price of the other. The analyst must carefully weigh the myriad intangible factors that influence this crucial multiplier. The primary determinant is the market's collective verdict regarding the general, long-term prospects of the industry. The financial herd frequently exhibits profound, irrational biases, assigning massive premiums to sectors bathed in contemporary glamour while severely penalizing essential, albeit unexciting industries. These collective prejudices, often rooted in an unthinking extrapolation of recent trends, are as likely to be disastrously wrong as they are to be right. The perceived quality of executive management acts as another powerful yet highly nebulous influence on the capitalization rate. Wall Street is perpetually infatuated with the concept of visionary leadership, but the intelligent analyst must exercise extreme caution. In the vast majority of cases, the brilliance of the management team has already been perfectly quantified and reflected within the company's historical record of profitability and growth. To assign an additional, separate premium to the stock price simply because the management is highly regarded is a dangerous double counting that leads directly to egregious overvaluation. The analytical utility of assessing management is most potent when evaluating a recent sweeping change in executive leadership, where the impact of the new regime has not yet materialized within the published financial statements. Furthermore, the corporation's underlying financial strength exerts a commanding influence on the multiplier. An enterprise overflowing with surplus cash reserves and entirely devoid of long-term debt mathematically commands a superior valuation compared to a heavily leveraged competitor producing identical per-share earnings. The analyst must also place immense weight upon the historical continuity of dividend distributions. An unbroken, multi-decade record of returning cash to the owners is one of the most persuasive, irrefutable indicators of supreme corporate quality. The prevailing attitude toward the current dividend rate, however, has undergone a radical transformation. Historically, a robust payout was demanded to sustain a high valuation. Today, the market willingly ignores anemic dividends or the total absence thereof, provided the enterprise is experiencing rapid exponential expansion. The intelligent allocator must navigate this shift with a critical eye, demanding either a traditional, generous distribution of profits or absolute, undeniable proof that the retained capital is generating a spectacular, compounding rate of return for the underlying business. The most intense, highly theoretical debates within the analytical profession revolve around the proper valuation of these rapidly compounding growth stocks. To navigate this perilous territory, a simplified, foreshortened mathematical formula provides a grounding alternative to the dizzying, esoteric calculus frequently deployed on Wall Street. The intrinsic value of a growth enterprise can be roughly approximated by multiplying its current, normalized earnings by a baseline factor of 8.5, plus twice the confidently expected annual growth rate over the subsequent decade. When this formula is reverse-engineered to dissect the astronomical market quotations of the era's most celebrated technological titans, a vital truth emerges. To justify their massive valuations, the market is assuming a rate of future expansion that borders on the impossible. The rational analyst is forced to deliberately understate these growth projections, embedding a severe margin of safety into the mathematics. If the enterprise somehow achieves the impossible and sustains its exponential ascent, the owner is handsomely rewarded. But if the growth inevitably decelerates, the conservative valuation shields the capital from total annihilation. The injection of advanced calculus and higher algebra into this highly uncertain endeavor is a massive warning sign, indicating that the analyst is attempting to mask rampant speculation beneath a deceptive veneer of scientific precision. It must also be permanently remembered that all projections of future value are violently hostage to the trajectory of macroeconomic interest rates. A rising yield environment ruthlessly compresses the present value of all distant, anticipated corporate profits. The security analyst frequently dedicates vast oceans of time to the exhaustive study of broad industrial trends, seeking to identify the overarching economic forces that will propel specific sectors to dominance. While these massive, multi-volume industry reports are visually impressive, their practical utility for the intelligent allocator is severely limited. The data synthesized within these documents is almost universally known to the broader financial community, meaning the anticipated future prosperity is already thoroughly baked into the prevailing market prices. The analyst rarely uncovers a looming sector-wide catastrophe or a guaranteed boom that the collective market has entirely missed. However, the relentless, accelerating pace of modern technological innovation does provide a legitimate, albeit hazardous, arena for independent investigation. By conducting exhaustive field research and maintaining close contact with the architects of new commercial processes, an analyst might occasionally secure a profound, early understanding of a transformative technology. Yet, the allocator must recognize the immense peril of paying exorbitant premiums for unproven futuristic concepts. They must constantly weigh the intoxicating potential of visionary profits against the absolute, grounding requirement for demonstrable present-day value. To instill a deeper, more rigorous discipline into the profession, a radical two-tiered architecture for corporate appraisal should be universally adopted. The foundation of this method demands the calculation of a past performance value, a completely mechanized, objective derivation rooted entirely in the company's historical ledger of profitability, stability, and growth. This initial appraisal assumes, with cold mathematical neutrality, that the corporation's past trajectory will extend uniformly into the future. Once this baseline is established, the senior analyst exercises their critical judgment, modifying the valuation strictly to account for specific anticipated deviations from the historical trend. This dual-pronged methodology forces the evaluator to explicitly isolate and defend the exact premium they are assigning to the uncertain future. While the chaotic, unpredictable nature of heavy industry may ultimately defy even this rigorous framework, the discipline of separating historical reality from future prophecy creates an invaluable repository of analytical experience. Ultimately, the most successful practitioners will learn to confine their efforts to sectors of high predictability, or they will insist upon such a massive, undeniable discount to the past performance value that the unpredictable shocks of the future are completely absorbed by an impenetrable margin of safety. The fundamental puzzle facing every allocator of capital is determining the precise monetary value to assign to an equity. The chasm between a business worth 10 times its earnings and one commanding 20 times its profits must be navigated with extreme prejudice. To ensure one does not pay an exorbitant ransom for a radiant future that ultimately degrades into a dismal reality, 5 indispensable pillars of valuation must be scrutinized: the enduring macroeconomic prospects of the enterprise, the inherent caliber of its leadership, the impregnability of its financial architecture, its historical consistency in distributing cash, and its present dividend yield. To gauge the true long-term prospects of an enterprise, the modern defensive allocator must plunge into the unglamorous depths of regulatory filings, extracting at least half a decade of annual reports to unearth the actual engines of corporate growth. The central investigation must isolate exactly where the profits originate and how they are sustained. A multitude of red flags demand an immediate retreat. The habitual acquirer, the corporate glutton that perpetually swallows other businesses only to predictably regurgitate them later through massive accounting write-offs, signals a management team that lacks faith in its own internal operations and routinely destroys shareholder wealth. The enterprise addicted to other people's money, relentlessly issuing new equity or debt to mask an inability to generate organic cash flow, operates as a dangerous financial illusion. Similarly, the fragile enterprise tethered entirely to the patronage of a single dominant client is a catastrophic risk waiting to materialize. Conversely, the intelligent mind hunts for the presence of a wide economic moat, a structural, almost insurmountable competitive fortress built upon unshakable brand loyalty, monopolistic market dominance, massive economies of scale, or irreplaceable intangible assets. The ideal enterprise is a marathoner, exhibiting steady, relentless compounding rather than the spectacular, unsustainable bursts of a sprinter destined to collapse from exhaustion. Furthermore, the business must demonstrate an unwavering commitment to sowing the seeds of its future through consistent, rational expenditures on research and development. The stewards of the corporation must be ruthlessly evaluated on the alignment of their actions with their public promises. The historical record must verify that they acknowledge missteps with absolute candor rather than deflecting blame onto the broader economy or sudden shifts in consumer demand. Crucially, the allocator must determine if the executives are operating the enterprise for the ultimate benefit of the outside owners or merely enriching themselves. Obscene, unjustifiable compensation packages or the shameful practice of repricing worthless stock options to protect insiders from the consequences of their own failures are glaring indicators of a parasitic leadership culture. The silent, insidious dilution caused by massive option grants systematically transfers wealth from the rightful owners to the management class, and this overhanging dilution must be rigorously factored into any appraisal of future value. Frequent, heavy liquidation of shares by the very individuals running the company deeply undermines any pretense of aligned interests. The true executive is a disciplined manager, not a carnival promoter. They dedicate their energies to the silent, efficient operation of the business rather than the relentless, aggressive hyping of the stock price or the desperate, short-term game of managing quarterly earnings expectations. When accounting maneuvers are deliberately employed to obscure economic reality, when massive, one-time charges become a permanent, recurring fixture and imaginary pro forma metrics replace actual profitability, the intelligent mind recognizes a leadership structure that places deception above fiduciary duty. The absolute, irreducible definition of a magnificent business is an entity that organically produces vastly more cash than it consumes. While traditional net income and earnings per share are easily manipulated through accounting alchemy and the issuance of stock options, the true measure of profitability lies in the rigorous calculation of owner earnings. This metric calculates the actual unencumbered cash the business deposits into the owner's pocket, neutralizing the distortions of depreciation and deducting the mandatory capital expenditures required simply to keep the business breathing. When evaluating this authentic cash generation, the hidden costs of executive stock options and the artificial, unsustainable returns generated by corporate pension funds must be ruthlessly expunged. The resulting figure, when compared against the total capital deployed by the enterprise, reveals the true return on invested capital. A double-digit return on this invested capital is the hallmark of an exceptional, highly efficient economic engine. The balance sheet must also reflect a fiercely conservative capital structure, with long-term debt representing a definitively minority portion of the total capitalization. The historical earnings must cover the fixed interest charges with a massive, impenetrable margin of safety, ensuring the enterprise cannot be easily seized by its creditors during an economic drought. The absence of a cash dividend places a tremendous, almost insurmountable burden of proof upon the corporate leadership. If the enterprise is retaining all of its cash, it must definitively prove that it is compounding that capital at rates vastly superior to what the shareholders could achieve independently. When a business falters or trails its competitors while hoarding cash, the management is guilty of squandering the owner's wealth. Furthermore, the cynical deployment of stock splits to artificially stimulate speculative enthusiasm is an insult to the intelligence of the investing public. Exchanging a single $50 share for two $25 shares alters the underlying economic value, not one iota. Finally, while the repurchase of corporate shares can be a magnificent allocation of capital when the stock is demonstrably undervalued, modern managements frequently execute massive buybacks at exorbitant prices simply to mask the dilution caused by their own excessive stock option grants. This practice represents a profound, cynical destruction of shareholder wealth, underscoring the absolute necessity of evaluating a business not by the optimistic promises of its promoters, but by the cold, unyielding reality of its financial mechanics. Chapter 12. Things to consider about per-share earnings. The examination of corporate earnings demands the acceptance of two inherently contradictory pieces of counsel. The first directive is an absolute imperative. One must never place profound reliance upon the earnings reported for any single, isolated year. The second directive immediately complicates the first. If an individual simply cannot resist the temptation to scrutinize short-term earnings, they must traverse the financial terrain with extreme caution, remaining perpetually vigilant for the hidden explosive devices buried deep within the per-share calculations. If the first rule were strictly obeyed, the second would be entirely superfluous. However, the financial establishment places such overwhelming obsessive emphasis upon quarterly and annual figures that it is virtually impossible for the average participant to remain insulated from their psychological impact. Therefore, a rigorous education in the deceptive arts of corporate accounting is absolutely vital, for the published numbers are frequently a labyrinth of misleading possibilities. Consider the hypothetical examination of a major industrial enterprise, such as the Aluminum Company of America, issuing its annual report at the close of a difficult economic year. A cursory glance at the headline figures might suggest a relatively stable performance, with the per-share earnings appearing only slightly diminished from the prior, more prosperous year. A superficial observer might swiftly calculate the price-to-earnings ratio and conclude that the shares represent a magnificent, undervalued bargain compared to other industrial titans. Yet, if this observer possessed the diligence to plunge into the dense, unglamorous thicket of the footnotes, a vastly different reality would emerge. Instead of a single, definitive earnings figure, the footnotes might reveal a staggering array of alternative calculations. Primary earnings, net income heavily adjusted for special charges, and figures further diminished by the specter of full dilution. If the earnings for the final quarter were stripped of all adjustments and annualized based on the raw net income, the seemingly cheap valuation would instantly evaporate, revealing an equity priced at a dangerously exorbitant multiple of its actual, unvarnished profitability. The first illusion that must be ruthlessly dispelled is the failure to account for dilution. When an enterprise issues substantial quantities of convertible bonds or stock purchase warrants, it creates a looming shadow over the common equity. To calculate the true underlying earning power of the common shares, one must operate under the assumption that these conversion privileges will inevitably be exercised the moment it becomes profitable for the holders to do so. This expansion of the share count permanently dilutes the earnings pool. While in some instances the dilution is a mere fraction in highly leveraged corporate structures, the sudden materialization of these phantom shares can effectively slice the apparent per-share earnings in half. The intelligent mind must never accept a headline earnings figure without first demanding to know the fully diluted reality. The far more insidious deception involves the deployment of special charges. In the aftermath of a brutal economic contraction, a curious epidemic frequently sweeps through corporate boardrooms. Management teams suddenly discover an urgent need to write off massive anticipated future costs. The closing of obsolete factories, the phasing out of unprofitable divisions, or the abandonment of disastrous acquisitions. By gathering all these future losses and aggressively burying them into a single already disappointing calendar year, the corporation effectively cleanses its future income statements. This maneuver guarantees that the earnings reported in subsequent years will appear artificially robust, entirely liberated from the burden of the losses that were conveniently pulled forward. It is a masterpiece of cynical accounting, akin to a sundial constructed to count only the brilliantly sunny hours while entirely ignoring the dark. This manipulation of time is frequently compounded by the distortion of tax liabilities. When massive special charges are taken, they can generate enormous tax credits that shield future profits from the revenue service. A corporation that suffers a staggering catastrophic loss in one era may suddenly report magnificent earnings in the next, not because its underlying business has miraculously recovered, but simply because it is temporarily operating entirely free of the burden of income taxes. To accept these tax-free profits as a genuine measure of sustainable earning power is a profound analytical error. The proper, conservative methodology demands that the earning power be calculated as if the full, normal tax liability were being paid, treating the temporary tax exemption merely as a finite, rapidly depleting bonus rather than a permanent feature of the business. The arsenal of accounting alchemy extends far beyond special charges and tax credits. Corporate earnings can be drastically altered by the stroke of a pen depending upon how depreciation is calculated. Shifting from an accelerated schedule to a straight-line method instantly inflates reported profits without generating a single extra dollar of actual cash flow. Similarly, the decision to instantly expense the costs of research and development versus slowly amortizing them over a decade radically reshapes the income statement. Even the mundane mechanics of inventory valuation, the choice between assuming the first items produced were the first sold versus the last items produced, can manufacture vast swings in reported profitability during inflationary environments. The more fervently the market fixates upon minor fractional changes in per-share earnings, the more aggressively corporate leadership will deploy these accounting variables to manufacture the exact, smooth progression of profits that Wall Street so desperately craves. To combat these illusions and to iron out the unpredictable, violent fluctuations of the standard business cycle, the intelligent allocator must rely upon a long-term average of earnings. By aggregating the corporate profits over a formidable span of time, perhaps 7 to 10 years, the analytical picture is beautifully clarified. A multi-year average acts as a massive shock absorber, effortlessly neutralizing the distortion of special charges and accounting gimmicks. Because these exceptional losses and gains are an undeniable, inevitable component of the corporation's true operating history, they absolutely belong within the long-term calculation. When a prolonged average is utilized in conjunction with a sober assessment of financial strength, it yields a profoundly accurate, unmanipulated portrait of the enterprise's true economic power. This historical perspective naturally flows into the vital measurement of corporate growth. The expansion of an enterprise must be factored into its valuation, but calculating this trajectory requires the same steady, long-term lens. The most reliable mechanism for capturing true, sustainable growth is to compare the average earnings of the 3 most recent years against the corresponding 3-year average from a full decade prior. This smooths out the anomalous spikes and sudden depressions that can violently skew a simple point-to-point comparison. However, one must be prepared for the ultimate, frustrating paradox of the financial markets. Robust historical growth does not guarantee a generous market valuation. A towering industrial enterprise might demonstrate a meticulously calculated, decade-long growth rate that vastly outperforms its peers and the broader market indices. Yet, the stock exchange might simultaneously punish those exact shares with a dismally low price-to-earnings multiplier. This apparent contradiction occurs because the market is a forward-looking mechanism. If the collective wisdom of the crowd determines that the corporation's future profitability, specifically its ability to generate an adequate return on its newly deployed capital, is destined to falter, the magnificent achievements of the past will be entirely disregarded. This reinforces the profound difficulty of the appraisal process. A mechanical valuation based strictly on historical performance might suggest an enterprise is a magnificent bargain. but the allocator must still exercise extreme independent judgment to determine if the dark clouds of future expectation have permanently impaired the underlying economic engine. The modern financial ecosystem is fundamentally addicted to the theatrical spectacle of the quarterly earnings report. Every 3 months, the entire machinery of Wall Street grinds to a halt to obsess over a single, highly manipulated number, the earnings per share. Corporate executives, terrified of the brutal punishment the market inflicts upon those who miss the consensus estimate by even a single penny, are placed under immense structural pressure to ensure their reported profits glide upward on a smooth, uninterrupted trajectory. This relentless demand for predictable growth transforms the accounting department from a sober recording mechanism into an active, creative participant in the engineering of financial illusions. The intelligent allocator must approach the corporate income statement not as a statement of infallible scientific fact, but as a carefully crafted narrative that demands rigorous, hostile cross-examination. The most pervasive and dangerous of these modern financial fictions is the proliferation of pro forma earnings. Translated from its Latin origin, the phrase essentially means as a matter of form, but in the contemporary corporate lexicon, it effectively translates to earnings before all the bad stuff happened. When an enterprise reports its official, legally mandated profits under strict accounting principles, it frequently releases a simultaneous, highly publicized pro forma figure. This alternative calculation conveniently strips out the costs of closed factories, severed employees, failed acquisitions, and depreciated inventory, categorizing them as unusual or one-time events. Yet for many chronically struggling corporations, these one-time catastrophic charges miraculously occur every single quarter. By demanding that the public focus solely on the idealized pro forma number, management is asking the investor to evaluate the business based on a fantasy where mistakes have no financial consequence. Equally treacherous is the widespread reliance on metrics like EBITDA, earnings before interest, taxes, depreciation, and amortization. While championed by corporate promoters and private equity operators as a purer measure of cash flow, it is a deeply flawed metric that deliberately ignores the very real, inescapable costs of maintaining a commercial empire. Depreciation is not a mere accounting fiction. It is the agonizingly real cost of machinery wearing out, factories rusting, and technology becoming obsolete. To evaluate a capital-intensive business while ignoring the cost of replacing its degrading assets is akin to evaluating the profitability of an airline while ignoring the cost of jet fuel. As seasoned financial minds have bluntly observed, a business does not magically generate wealth if it requires massive, continuous capital expenditures simply to remain stationary. The sophisticated manipulation of corporate earnings frequently extends deep into the labyrinth of the corporate pension fund. For decades, massive industrial enterprises maintained heavily funded pension plans for their workforces. Because the accounting rules permit corporations to estimate the future returns of these vast investment portfolios, a deeply cynical maneuver became commonplace. By merely raising the assumed rate of return on the pension assets by a fraction of a percent, the corporation could instantly reduce its required cash contributions and miraculously manufacture millions of dollars in phantom operating profit. This earnings growth was entirely decoupled from the actual manufacturing or selling of the company's products. It was the product of optimistic actuarial assumptions. When the stock market inevitably contracted and those assumed returns failed to materialize, these pension funds swung from massive surpluses to terrifying deficits, violently wiping out the phantom earnings of the past and demanding devastating injections of actual corporate cash. The intelligent mind must also confront the silent, insidious wealth transfer executed through executive stock options. When corporate leadership compensates itself with massive grants of stock options, they are issuing a dual threat to the outside shareholder. First, if the options are not properly expensed on the income statement, the company's true labor costs are being artificially suppressed, drastically inflating reported profitability. Second, when those options are eventually exercised, they flood the market with millions of new dilutive shares, permanently reducing the existing owner's fractional claim on the future wealth of the enterprise. A management team that aggressively hides the true cost of its own compensation behind accounting loopholes is demonstrating a profound contempt for its outside partners. The ultimate antidote to this systemic deception is a radical shift in the investor's reading habits. The amateur begins reading an annual report at the glossy front cover, soaking in the optimistic letters from the chief executive and the vibrant photographs of expanding facilities. The intelligent allocator ignores the promotional material entirely and begins reading from the absolute back of the document, plunging directly into the dense, microscopic text of the financial footnotes. It is within the footnotes that the corporate bodies are buried. It is here that the company must legally disclose the aggressive assumptions regarding its pension returns, the true extent of its off-balance sheet debt, the shifting methods of inventory valuation, and the looming threat of impending litigation. Furthermore, the defensive mind must elevate the statement of cash flows above the easily manipulated income statement. While net income is an opinion shaped by accounting assumptions, cash is an undeniable physical fact. A business cannot pay its debts, issue dividends, or acquire competitors with pro forma adjustments or accounting goodwill. It can only do so with cold, hard cash. If an enterprise is consistently reporting magnificent record-breaking net income while its cash flow from actual operations is simultaneously plunging, it is a glaring mathematical alarm bell indicating that the reported earnings are a dangerous illusion. Would you like me to proceed to Chapter 13? A comparison of 4 listed companies? Chapter 13. A comparison of 4 listed companies. To transition from the abstract realm of financial theory into the practical, unforgiving theater of the stock exchange, the intelligent allocator must examine how the broad principles of security analysis are applied to specific, living enterprises. To eliminate the subtle deception of hindsight bias, the temptation to handpick companies that perfectly prove a predetermined point, the selection of these test subjects should be almost arbitrary. For this comparative exercise, we shall examine 4 manufacturing and service corporations whose names happen to sit adjacent to one another in the alphabetical registry of the exchange: Eltra Corporation, Emerson Electric, Emery Air Freight, and Emhart Corporation. By placing these 4 diverse entities side by side, the stark contrast between the sober, underlying economic value of a business and the manic, frequently irrational valuation assigned to it by the stock market is brilliantly illuminated. The initial phase of this comparative autopsy requires laying out the fundamental financial anatomy of each enterprise. Eltra and Emhart represent the unglamorous, heavy industrial foundation of the economy, manufacturing electrical equipment, footwear, and hardware machinery. Emerson Electric occupies a slightly more elevated, expanding sector of electrical products, while Emery Air Freight operates as a highly visible, rapidly expanding logistics and forwarding enterprise. The analyst first examines their historical records of profitability, stability, and growth over the preceding decade. In this retrospective view, Emery Air Freight emerges as the undisputed champion of sheer expansion, having multiplied its revenues and earnings at a breathtaking pace. Emerson Electric similarly displays a magnificent, unbroken trajectory of compounding growth. Eltra and Emhart, conversely, exhibit the plodding, cyclical, entirely unspectacular progress typical of mature industrial manufacturers, possessing adequate stability but lacking any thrilling narrative of exponential ascent. However, the true test of the intelligent mind begins when these historical operational realities are violently juxtaposed against their prevailing market quotations. When the analyst calculates the price-to-earnings ratios, the multiple the market is demanding for each dollar of generated profit, a staggering divergence appears. The market, utterly intoxicated by the brilliant historical growth of Emery Air Freight, demands a catastrophic premium for its shares, pricing the enterprise at nearly 60 times its recent earnings. Emerson Electric, similarly beloved by the public, commands a formidable multiple of more than 30 times its profits. Meanwhile, the unglamorous, sturdy workhorses, Eltra and Emhart, languish in the desolate valleys of market neglect, trading at a mere 10 times their earnings. This monumental discrepancy in valuation forces the allocator to confront the central, agonizing dilemma of the financial markets. How much of a premium is a rational individual willing to pay for the promise of future growth? To justify the astronomical multiple assigned to Emery Air Freight, the enterprise must not merely continue its spectacular expansion, it must accelerate it flawlessly into the indefinite future. The buyer of Emery is paying a massive, unforgiving ransom in advance for decades of unbroken perfection. If the company suffers even a momentary deceleration in its growth rate, a virtual inevitability in the physical world of commerce, the multiple will violently compress and the shares will suffer a wealth-eradicating collapse. The margin of safety in such an acquisition is entirely non-existent. The investor is balancing on a razor's edge of absolute optimism. To further expose the terrifying fragility of these high-flying growth valuations, the analyst must subject the four enterprises to the grounding gravity of their tangible book value. The book value represents the cold, hard, physical reality of the corporation. Its cash, its factories, its inventory, stripped of all future hopes and speculative dreams. Eltra and Emhart, the discarded industrial orphans, trade at prices roughly equivalent to their tangible book value. The buyer is effectively acquiring a massive, functioning, profitable enterprise and paying nothing for the ongoing business franchise or the underlying goodwill. In stark contrast, Emery Air Freight trades at an astonishing, logic-defying premium of nearly 20 times its tangible book value. To acquire $1 of actual physical assets in Emery, the public is frantically willing to surrender $20 of capital, entrusting the remaining $19 entirely to the fragile illusion of perpetual momentum. The fundamental financial fortifications of these enterprises further underscore the madness of the crowd. The intelligent allocator demands an impregnable balance sheet, requiring a current ratio, current assets divided by current liabilities, of at least 2 to 1, and a capital structure where the common equity vastly outweighs any long-term debt. When subjected to these stringent tests, the unloved Eltra and Emhart display absolute fortress-like financial strength, possessing vast reservoirs of working capital and remarkably low burdens of debt. Emery Air Freight, despite its stratospheric valuation, operates with a considerably weaker, more precarious financial structure, relying heavily on borrowed capital to sustain its rapid expansion. The market is thus assigning its highest, most spectacular premium to the enterprise possessing the weakest structural foundation. The dividend yield provides the final damning metric of comparison. The conservative allocator relies upon a steady, robust stream of dividend income as a vital psychological and mathematical anchor, ensuring a tangible return on capital regardless of the stock market's daily hysterics. Eltra and Emhart offer generous, highly attractive dividend yields historically protected by their substantial earnings and deep cash reserves. The buyers of Emerson and Emery, however, must completely forfeit this vital stream of income. Because their market prices are so astronomically inflated relative to their underlying profits, their dividend yields are compressed to microscopic, almost non-existent fractions of a percent. The owners of these glamour stocks are entirely, dangerously reliant upon the stock market, continually bidding up the price of their shares to generate any return on their capital. This deliberate comparison of four randomly grouped enterprises yields a profound, timeless directive for the formulation of portfolio policy. The active pursuit of the recognized, universally celebrated growth stock, typified by Emery and Emerson, is an inherently speculative, treacherous endeavor. It demands that the individual accurately forecast a brilliant future while simultaneously paying a price that mathematically guarantees disaster if that future proves even slightly imperfect. The true province of the intelligent, defensive allocator resides in the quiet, unglamorous territory occupied by Eltra and Emhart. By acquiring these thoroughly unexciting, financially impregnable enterprises at valuations deeply tethered to their physical book value and fortified by generous dividend yields, the investor secures the ultimate financial prize, an impenetrable margin of safety. While the public furiously chases the intoxicating illusion of infinite growth, the rational mind quietly accumulates tangible wealth, perfectly content to sacrifice the thrill of the casino for the absolute mathematical certainty of long-term preservation. The brutal, unforgiving laboratory of the stock market consistently proves that the price you pay determines the return you will ultimately receive. When the intelligent allocator conducts a side-by-side autopsy of competing enterprises, the most glaring, dangerous anomaly they encounter is the astronomical premium the crowd is willing to pay for the illusion of certainty. The public desperately craves the comfort of a smooth, upward-sloping chart, and they will surrender vast fortunes to acquire the shares of companies that promise an unbroken trajectory of rapid growth. Yet, as the comparison of our four structural archetypes vividly demonstrates, the financial laws of gravity cannot be permanently suspended. To fully grasp the peril of the high-flying growth stock, one must understand the mathematics of perfection. When a company trades at 50, 60, or 100 times its earnings, the market has priced in a flawless future. Every conceivable piece of good news, years of unblemished execution, massive market share expansion, and pristine profit margins is already baked into the current quotation. The buyer of such an equity is balancing on the edge of a razor. If the company delivers anything less than absolute perfection, if a new competitor emerges, if macroeconomic conditions sour, or if management simply stumbles, the premium instantly evaporates. The underlying business might still be highly profitable, but because the market's euphoric expectations were shattered, the stock price suffers a catastrophic, wealth-eradicating collapse. We need only look at the modern equivalents of Emery Air Freight during the technological euphoria of the late 1990s or the more recent speculative manias surrounding electric vehicles and digital software platforms. In these eras of rampant speculation, companies were routinely priced not merely at exorbitant multiples of their earnings, but at staggering multiples of their sales, completely divorcing the stock price from any rational tether to underlying cash flow. The public eagerly bought into the narrative that these businesses would change the world, ignoring the mathematical reality that paying 100 times revenue guarantees a negative return, even if the company eventually achieves dominance. When the inevitable reversion to the mean occurred, the wealth destruction was absolute, leaving retail investors holding the shattered remnants of once glamorous portfolios. Conversely, the profound advantage of the boring, unglamorous enterprise lies in the simple fact that it does not need to conquer the world to reward its owners. Companies that manufacture mundane necessities, whether it be asphalt, industrial fasteners, or basic electrical components, rarely capture the imagination of the financial press. Because they are ignored, their shares languish at highly compressed valuations, often trading near or even below their tangible book value. The expectations baked into these prices are dismally low. If the company merely survives and continues to churn out a modest profit, the investor is handsomely rewarded by a robust dividend yield. And if the company surprisingly improves its operations or benefits from a cyclical economic tailwind, the stock price can experience a massive upward revaluation. The buyer of the mundane value stock enjoys a built-in margin of safety. The bar for success is set so low that even a mediocre performance can yield a highly satisfactory result. When conducting a comparative analysis today, the defensive allocator must strictly enforce a mechanical checklist to pierce through the noise of corporate promotion. Return on invested capital, ROIC. This is the ultimate unvarnished measure of corporate efficiency. Does the business generate a robust cash return on the capital it deploys, or does it constantly require massive infusions of new cash just to tread water? Financial fortification. A fortress balance sheet is non-negotiable. The analyst must strip away the accounting jargon and compare the total unencumbered cash against the total long-term debt. A business swimming in debt is entirely at the mercy of its creditors and shifting interest rates. The price-to-value disconnect. Compare the price-to-earnings, PE, and price-to-book, PB ratios against the company's own historical averages and its direct competitors. A magnificent business is a terrible investment if acquired at the wrong price. Ultimately, the comparative exercise forces the investor to make a definitive choice between the thrill of the casino and the quiet, plodding arithmetic of wealth accumulation. The public will forever be seduced by the glamorous narrative of the next revolutionary enterprise. The intelligent mind, however, recognizes that the most profound financial victories are often achieved by systematically acquiring the boring, the neglected, and the deeply undervalued. Chapter 14. Stock Selection for the Defensive Investor. For the defensive allocator, the agonizing burden of security selection can be entirely, elegantly bypassed through the modern architecture of the broad market index fund. By simply acquiring a cross-section of the entire corporate landscape, the individual secures the ultimate, perfectly average return, free from the psychological torment of picking winners and the financial friction of active management. However, for those who find the absolute passivity of the index fund intellectually unsatisfying, the assembly of a personal direct portfolio of equities remains a viable pursuit. Yet this pursuit must be governed not by intuition or market enthusiasm, but by a set of rigid mechanical filters designed to ruthlessly eliminate any enterprise harboring an unacceptable degree of risk. The defensive investor does not seek to uncover the next obscure revolutionary titan. they seek to acquire the undisputed, impregnable champions of the present economy at prices that guarantee a profound margin of safety. To achieve this mathematically grounded defense, the allocator must subject every prospective equity to a grueling gauntlet of 7 specific criteria, demanding both absolute quality of the underlying business and undeniable quantity of value in the prevailing market price. 1. Adequate size of the enterprise. The defensive portfolio is no place for fragile, unproven ventures. The enterprise must possess massive physical and economic gravity to ensure it can withstand severe macroeconomic tempests. The allocator must intentionally exclude small secondary companies, as they are inherently vulnerable to sudden, devastating vicissitudes in their specific industries. 2. A sufficiently strong financial condition. The corporate balance sheet must resemble an impenetrable fortress. For an industrial enterprise, current assets must be at least twice the current liabilities, a standard 2-to-1 current ratio, ensuring absolute short-term liquidity. Furthermore, the burden of long-term debt must never exceed the net current assets, working capital. A corporation suffocating under the weight of borrowed money is entirely at the mercy of its creditors during an economic drought. 3. Earnings stability. The historical ledger must demonstrate an unbroken streak of profitability. The enterprise must have reported some positive earnings for the common stock in each of the past 10 consecutive years. A single year of deficit within the preceding decade is a glaring red flag, immediately disqualifying the equity from the defensive portfolio. 4. Dividend record. An uninterrupted history of dividend payments is the ultimate proof of enduring corporate vitality. The defensive allocator should demand a continuous, unbroken record of dividend distributions stretching back for at least 20 years. This ensures the investor receives a steady, tangible return on capital, serving as a vital psychological anchor when market prices inevitably fluctuate. 5. Earnings growth. The business must demonstrate a capacity to outpace the invisible confiscation of inflation. The allocator should demand a minimum increase of at least 1/3, 33%, in per-share earnings over the past 10 years. To smooth out anomalous spikes, this growth should be calculated by comparing the average earnings of the 3 most recent years against the corresponding 3-year average from a full decade prior. 6. Moderate price-to-earnings ratio. The defensive investor must absolutely refuse to pay an exorbitant premium for future promises. The current market price of the stock should not exceed 15 times the average earnings of the past 3 years. This unyielding ceiling deliberately excludes the vast majority of glamorous, highly touted growth stocks, permanently tethering the investor's capital to sober, present-day reality. 7. Moderate ratio of price to assets. The final valuation must be grounded in the physical reality of the business. The current market price should not exceed 1.5 times the tangible book value last reported. However, a slightly higher premium over book value can be tolerated if the price-to-earnings multiple is exceptionally low. To harmonize these 2 valuation metrics, the allocator can apply a simple rule of thumb. The product of the P/E ratio multiplied by the price-to-book ratio should not exceed 22. 5. The mathematical offspring of 15 multiplied by 1.5. This crucial threshold is famously known as the Graham number. When applied with unyielding discipline, these 7 filters will immediately disqualify 99% of the equities traded upon the public exchanges. What remains is a highly exclusive, deeply unglamorous roster of robust, mature enterprises trading at eminent bargains. By constructing a diversified basket of 10 to 30 such equities, the defensive investor locks in a massive, mathematical margin of safety, completely divorcing their ultimate financial destiny from the manic, unpredictable mood swings of the broader stock market. Commentary on Chapter 14. The 7 criteria laid out for the defensive investor are not merely a screening mechanism, they are an absolute, uncompromising financial philosophy. They serve as a massive reinforced seawall designed to protect the amateur allocator from the seductive, destructive sirens of Wall Street. However, the relentless march of time and inflation requires that we modernize the specific numerical thresholds of this methodology while preserving its underlying architecture. The demand for adequate size was originally quantified as $100 million in annual sales for an industrial company. Adjusted for decades of inflation and the sheer scale of the modern global economy, a defensive investor today should insist upon a minimum total market capitalization of at least $2 billion. A company smaller than this threshold simply lacks the immense economic moat required to guarantee survival during a severe, protracted recession. The requirement of a 20-year uninterrupted dividend record is perhaps the most arduous hurdle in the modern era. Today, corporate executives frequently prefer to return capital to owners through massive share repurchase programs rather than taxable dividends. While buybacks can be highly efficient if executed when the stock is undervalued, they are often cynically deployed to mask the dilution of executive stock options. Therefore, while a 20-year dividend history remains the gold standard of corporate integrity, a modern defensive investor might slightly relax this stricture, provided the enterprise possesses an absolutely impregnable balance sheet and a massive, unquestionable history of free cash flow generation. The true magic of the defensive methodology lies in the final two criteria: the mathematical ceiling placed on the price-to-earnings and price-to-book ratios, culminating in the legendary Graham number. The Graham number establishes a hard, absolute maximum price that a rational individual should ever be willing to pay for an enterprise, regardless of how thrilling its future prospects appear in the financial press. By demanding that the PE multiplied by the PB never exceeds 22.5, the allocator permanently immunizes themselves against the disease of paying for hype. If you attempt to apply these 7 rigid filters to the modern stock market during a raging bull run, you will experience profound frustration. The screen will frequently yield 0 results. The most celebrated, culturally dominant technological empires will be instantly rejected because their valuations soar to 50 times earnings and 10 times book value. You will be left staring at a handful of deeply unfashionable businesses, manufacturers of industrial pipes, regional food distributors, or obscure insurance conglomerates. This is not a flaw in the system. It is the system functioning perfectly. The very essence of defensive investing is the courageous willingness to look incredibly foolish in the short term by holding boring, undervalued assets, while your neighbors seemingly grow wealthy overnight, trading glamorous illusions. When the inevitable market contraction arrives and the exorbitant multiples of the growth darlings violently collapse, the unglamorous, sturdy workhorses acquired at prices below their Graham number will stand as an impenetrable fortress, preserving your wealth while the speculators are entirely wiped out. For the vast majority of individuals who lack the time, the emotional detachment, or the sheer mathematical fortitude to relentlessly apply these 7 screens, the modern era offers an elegant, flawless alternative. The low-cost, broadly diversified index fund perfectly captures the essence of the defensive posture. By purchasing an index, you abandon the arrogant assumption that you can outsmart the collective wisdom of millions of participants, and you guarantee yourself the full compounding machinery of global capitalism for virtually 0 frictional cost. Chapter 15. Stock Selection for the Enterprising Investor. The enterprising allocator, having willfully rejected the passive tranquility of the defensive posture, steps into an arena that demands rigorous intellectual labor and an ironclad psychological constitution. The objective is not merely to participate in the general prosperity of the corporate landscape, but to actively exploit the pricing errors of the broader market to secure a superior return. However, this pursuit must not degenerate into a frantic speculative hunt for the next glamorous technological marvel. Instead, the enterprising mind operates as a disciplined, calculating bargain hunter, utilizing a modified, slightly more aggressive set of quantitative filters to identify fundamentally sound enterprises that the market has temporarily discarded. Because the enterprising investor is willing to accept a marginally higher degree of business risk in exchange for a significantly depressed purchase price, the rigid criteria applied to the defensive portfolio can be carefully relaxed. Yet this relaxation does not imply a surrender to recklessness. The boundaries remain strictly mathematical. The criteria for the active, enterprising portfolio are as follows. Financial condition. The fortress must still hold, but the walls may be slightly thinner. Current assets should equal at least 1.5 times current liabilities, a 1.5 current ratio, down from the defensive 2.0. Furthermore, total long-term debt should not exceed 110% of the net current assets. Earnings. Stability. the enterprise must have successfully avoided any annual deficits over the preceding 5 years, rather than the grueling 10-year pristine record demanded of the defensive portfolio. Dividend record. The absolute requirement of a multi-decade history of dividend distributions is abandoned. The enterprising investor simply demands that the company is paying some current dividend, proving its present capacity to return cash to the owners. Earnings growth. The demand for a steady, calculated expansion of profits is replaced by a simple binary hurdle. The earnings of the most recent year must demonstrably exceed the earnings reported 5 years prior. Price. The valuation ceiling is strictly enforced. The current market quotation should not exceed 120% of the net tangible asset value, book value. Alternatively, the price-to-earnings multiplier should remain exceptionally low, typically no more than 10 times the average earnings of the most recent years. By applying these modified filters, the active allocator unearths a vast array of secondary enterprises, companies that lack the colossal size and absolute permanence of the defensive titans, but which are currently priced at such severe discounts that the mathematical odds of a profitable outcome are heavily tilted in the buyer's favor. Beyond this filtered approach, the ultimate, most mathematically pure strategy for the enterprising mind is the relentless pursuit of the net current asset issue, frequently referred to as the net. This occurs when the stock market's pessimism becomes so profoundly irrational that it prices an entire corporation for less than the value of its working capital alone. To calculate this, the analyst takes the current assets, cash, marketable securities, and inventory, and subtracts every single liability and preferred stock obligation. If the resulting figure is higher than the total market capitalization of the company, a magnificent bargain exists. The buyer of a net is effectively acquiring the cash and inventory at a discount while receiving the factories, the equipment, the brand name, and the ongoing commercial business entirely for free. Historically, a diversified basket of these deeply depressed, seemingly hopeless enterprises has produced staggering, market-crushing returns, proving that purchasing a dollar for 50 cents remains the most infallible strategy in finance. Finally, the enterprising investor may dedicate a specialized fraction of their capital to the highly technical realm of special situations. This involves exploiting specific, announced corporate events, such as mergers, liquidations, spin-offs, or complex reorganizations. The profit in a special situation is not derived from predicting the future direction of the broader stock market, but from carefully calculating the mathematical spread between the current market price and the ultimate guaranteed payout of the corporate action, while rigorously assessing the risk that the deal might fall apart. Commentary on Chapter 15. The landscape of modern finance has been permanently altered by the relentless speed of digital information, rendering the hunting grounds of the enterprising investor infinitely more fiercely contested than they were in previous decades. The legendary net stock, the ultimate, mathematically perfect bargain, has been driven almost entirely into extinction. Today, when a company trades below its net working capital, it is typically a microscopic, illiquid enterprise, or a biotechnology firm burning through its final reserves of cash before an inevitable bankruptcy. To construct a broadly diversified portfolio composed exclusively of these pure bargains is now a practical impossibility outside of the most catastrophic generational market panics. Therefore, the modern enterprising mind must adapt, shifting their focus from the purely mechanical calculation of working capital to the behavioral exploitation of market revulsion. The true province of the active allocator today is contrarianism. But true contrarianism is not merely doing the opposite of the crowd for the sake of being stubborn. It is doing the opposite of the crowd when the crowd is mathematically wrong. To succeed, the enterprising investor must deliberately seek out the most unloved, heavily punished sectors of the economy. When a specific industry faces temporary headwinds, regulatory scrutiny, or a high-profile scandal, the institutional herd inevitably stampedes toward the exits, dumping shares with zero regard for underlying intrinsic value. It is within the smoking wreckage of these discarded sectors that the enterprising mind initiates their meticulous, calculating search. They must sift through the debris to identify the financially fortified survivors, enterprises possessing the unencumbered cash and the enduring business moats necessary to weather the temporary storm. By acquiring these dominant companies when their multiples are chronically compressed by collective disgust, The investor positions themselves for massive capital appreciation when the cycle inevitably turns and the market's memory fades. The active allocator must also master the vital metric of return on invested capital, ROIC. Because acquiring a company below its sheer liquidation value is rare, the investor must instead find businesses that are exceptionally efficient at compounding their retained earnings, yet are currently mispriced due to a temporary, solvable, operational hiccup. A company that consistently generates a 15% or 20% cash return on its deployed capital is a magnificent economic engine. If the market momentarily punishes that stock due to a missed quarterly earnings estimate or a broader macroeconomic panic, the enterprising investor seizes the opportunity to buy a compounding machine at a static, value-oriented price. Ultimately, the choice to become an enterprising investor is a choice to adopt a grueling secondary profession. It requires hundreds of hours of reading dense regulatory filings, ignoring the breathless hyperbole of the financial media, and enduring prolonged periods of looking incredibly foolish while your out-of-favor acquisitions languish. If you lack the fierce independence of mind to stand entirely alone against the consensus, or if you simply cannot dedicate the immense hours required to dissect corporate balance sheets, the active path will guarantee nothing but exhaustion and underperformance. For those individuals, the automated defensive embrace of the total market index remains the undisputed rational choice. Chapter 16. Convertible Issues and Warrants. The financial markets continually invent hybrid instruments designed to appeal to the conflicting desires of the investing public. The most prominent of these creations are convertible bonds and convertible preferred stocks. On their surface, these securities are marketed as the ultimate financial panacea. They promise the absolute safety and steady income of a senior debt obligation, coupled with the thrilling, unlimited upside potential of a common equity. The pitch is intensely seductive. If the underlying enterprise prospers, the investor can convert their bond into stock and reap the rewards. If the enterprise falters, the investor theoretically retains the impregnable protection of a creditor. However, the intelligent allocator must rigorously examine the mathematics beneath this marketing facade, for the reality of convertible issues is frequently a profound disappointment, perfectly illustrating the ancient maxim that one cannot have their cake and eat it too. The fundamental flaw in the convertible issue lies in the inherent compromise it demands. To acquire the privilege of conversion, the investor is invariably forced to sacrifice yield and accept inferior credit quality. When a corporation issues a convertible bond, it deliberately sets the interest rate significantly lower than what a standard, non-convertible bond of identical quality would require. Furthermore, the conversion price, the price at which the bond can be exchanged for common stock, is almost always set at a substantial premium above the current market quotation of the shares. Therefore, the buyer of a newly minted convertible is immediately penalized on two fronts. They receive an inadequate return on their loaned capital, and they must wait for a massive speculative surge in the stock price before the conversion feature possesses any tangible value. The identity of the issuing corporations provides a further glaring warning. Truly dominant, impregnably financed enterprises rarely issue convertible debt. They have no need to dilute their future equity to attract capital. They simply issue standard bonds at prime interest rates. The overwhelming majority of convertible issues are floated by secondary, rapidly expanding or financially precarious companies that cannot secure traditional financing without paying ruinous interest rates. By attaching the glittering lure of a stock conversion feature, these weaker enterprises successfully entice the public into lending them capital at artificially suppressed rates. When the macroeconomic weather turns hostile, the dual nature of the convertible issue proves to be a devastating liability rather than a protective shield. Because the issuing companies generally possess weaker financial foundations, their bonds do not behave like premium, safe harbor debt during a crisis. As the underlying stock price inevitably collapses, the conversion feature becomes utterly worthless. Simultaneously, the market severely discounts the bond itself due to the company's deteriorating creditworthiness and the inadequate interest yield. The investor, who believed they purchased the safety of a bond, suddenly finds themselves holding a rapidly depreciating asset that offers neither capital protection nor an adequate income. Conversely, if the enterprise succeeds spectacularly and the stock price soars, the convertible bond will indeed appreciate. Yet, in this optimistic scenario, the investor would have achieved a vastly superior return by simply acquiring the common stock directly, without paying the massive premium demanded by the convertible structure. A closely related but infinitely more toxic financial invention is the stock purchase warrant. A warrant is a pure, unadulterated instrument of speculation. It represents nothing more than the right to purchase a share of common stock at a specific price within a specific time frame. It provides no dividend income, it represents no ownership in the physical assets of the corporation, and it possesses no voting power. Warrants are frequently attached to new bond offerings to sweeten the deal, or they are issued directly to management. From the perspective of the existing common shareholder, the proliferation of warrants is an unmitigated disaster. They constitute a massive looming threat of dilution. If the enterprise struggles, the warrants expire worthless. But if the enterprise prospers and the stock price ascends, the warrant holders will inevitably exercise their rights, flooding the market with millions of newly minted shares at prices significantly below the prevailing market value. This sudden influx of cheap stock permanently dilutes the earnings per share and forcibly extracts wealth from the legitimate, risk-bearing owners of the corporation, transferring it directly to the speculators. The intelligent allocator should view the existence of massive quantities of outstanding warrants as a severe structural defect in any enterprise, demanding a drastic downward revision of the company's appraised value. Commentary on Chapter 16. The modern financial ecosystem still enthusiastically peddles the illusion of the best of both worlds. Wall Street possesses an insatiable appetite for manufacturing complexity, primarily because complexity is the ultimate justification for exorbitant fees. While the traditional retail investor rarely buys individual convertible bonds today, they are frequently herded into mutual funds specializing in these hybrid instruments. The marketing brochures promise a magical asset class that captures the lion's share of a bull market's upside while providing a concrete floor during a bear market. This is a dangerous half-truth. The actual mechanics of the modern convertible market have been entirely hijacked by professional arbitrageurs and hedge funds. These highly leveraged institutional players buy the convertible bond and simultaneously short-sell the underlying common stock, seeking to extract microscopic, risk-free profits from the mathematical discrepancies between the two instruments. This relentless automated trading completely distorts the pricing of the bonds, rendering the arena entirely hostile to the traditional, long-term investor. For the defensive allocator, the rule remains absolute. Complexity is your enemy. If you desire the safety of a bond, buy a premium, straightforward bond. If you desire the growth of an equity, buy a high-quality stock. Mixing the two in a single compromised instrument guarantees mediocre results and hidden risks. The modern mutation of the stock purchase warrant is an even greater scourge on the investing public, the executive stock option. While explicitly marketed as a mechanism to align the interests of management with the shareholders, the reality of the stock option is frequently a mechanism for legalized corporate looting. When executives grant themselves millions of stock options, they are essentially writing themselves a lottery ticket where the shareholders provide the payout. If the company's stock price falls, perhaps due to the executive's own incompetence, the options simply expire, and the executives lose nothing but an unrealized dream. They suffer no loss of actual capital. But if the stock price rises, even if that rise is entirely due to a general macroeconomic boom rather than any specific managerial brilliance, the executives exercise their options, instantaneously generating massive personal fortunes. Crucially, the arithmetic of this transaction is brutal for the outside investor. When options are exercised, the company must issue new shares, permanently expanding the denominator in the earnings per share calculation. The existing owner's slice of the corporate pie is forcibly shrunk to accommodate the management team. Even worse, many modern corporations desperately attempt to mask this dilution by executing massive share repurchase programs, using billions of dollars of corporate cash to buy back stock on the open market simply to offset the shares they just handed to their executives. This is a catastrophic misallocation of capital, redirecting cash that could have been used for research, expansion, or dividends into a circular scheme designed solely to enrich insiders. The intelligent investor must treat the footnotes detailing executive stock options as a critical warning system. If a company possesses a massive overhang of unexercised options, the analyst must aggressively recalculate the earnings per share, assuming every single one of those options will eventually dilute the stock. If this fully diluted reality destroys the apparent value of the enterprise, the investor must walk away. True alignment of interest does not come from risk-free options. It comes from executives buying common stock with their own hard-earned cash, subjecting themselves to the exact same risks and rewards as the public shareholder. Chapter 17. 4 extremely instructive case histories. To transform abstract financial theory into tangible protective wisdom, the intelligent allocator must study the forensic remains of past market disasters. It is one thing to acknowledge the theoretical dangers of overvaluation and excessive debt. It is an entirely different, profoundly educational experience to examine the specific historical instances where the public surrendered its collective sanity and suffered catastrophic losses. By dissecting 4 distinct corporate tragedies from recent financial history, we can illuminate the recurring patterns of hubris, aggressive accounting, and speculative frenzy that permanently destroy capital. 1. The Penn Central Transportation Company, the illusion of impregnability. For generations, the major railroads were considered the absolute bedrock of American industry, and the mighty Penn Central was the largest of them all. To the casual observer, its sheer physical size and deep historical roots suggested an impregnable safety. Yet the intelligent analyst, peering beneath the majestic facade and into the sober reality of the financial statements, would have seen a rotting foundation. Long before its shocking descent into bankruptcy, Penn Central was flashing glaring mathematical warning signs. Its fixed charge coverage, the vital ratio of earnings to interest obligations, had steadily deteriorated to a point where the company was effectively borrowing money simply to pay the interest on its older debts. The broader market, hypnotized by the company's legacy and massive asset base, completely ignored the horrific decay of its actual earning power. The ultimate collapse of Penn Central serves as a timeless, brutal reminder. Sheer size is never a substitute for financial health, and a chronic inability to cover interest charges is the undeniable prelude to ruin. 2. Ling Temco Vought, LTV, the conglomerate mirage. During the speculative euphoria of the 1960s, Wall Street became infatuated with the conglomerate, a corporate structure built upon the relentless, aggressive acquisition of entirely unrelated businesses. LTV was the quintessential champion of this era, expanding from a modest electronics firm into a sprawling, chaotic empire encompassing meatpacking, sporting goods, and steel. This explosive growth was not financed by internal profits, but by the reckless issuance of complex debt and convertible securities. Management discovered that by acquiring companies with lower price-to-earnings ratios and instantly applying LTV's artificially high multiplier to their earnings, they could manufacture the illusion of rapid, perpetual growth. The public eagerly swallowed this financial alchemy, bidding the stock up to staggering heights. Inevitably, the crushing weight of the debt caught up with the underlying operational mediocrity. When the macroeconomic weather turned, the earnings collapsed, the debt remained, and the stock price was virtually annihilated. The lesson is absolute. Rapid expansion fueled by the issuance of massive complex debt is not genuine growth, it is the construction of a financial house of cards. 3. NVF Corporation, the minnow, swallowing the whale. The saga of NVF illustrates the sheer absurdity that can infect the financial markets when debt becomes dangerously easy to issue. NVF, a relatively small, unexceptional manufacturer, launched a hostile takeover of Sharon Steel, an enterprise approximately 7 times its size. To finance this audacious acquisition, NVF did not use cash. Instead, it printed a massive mountain of low-grade, deeply subordinated debt, what we now term junk bonds, and offered them to Sharon Steel's shareholders. The sheer arithmetic of the transaction was a nightmare, immediately burdening the newly combined entity with a crushing, suffocating debt load that vastly exceeded its net working capital. The stock market, caught up in the frenzy of corporate raiding, initially cheered the maneuver. The intelligent investor, however, recognizes that using inferior paper to acquire hard assets at a premium is a recipe for structural failure. 4. Popo A Enterprises, the tragedy of the hot issue. The final case history represents the purest distillation of speculative madness, the initial public offering of an unproven, hyped concept. AAA Enterprises was a fledgling operator of mobile home dealerships, possessing minimal historical profits and a dangerously weak balance sheet. Yet, it was brought to the public markets during a feverish boom for concept stocks. Driven by aggressive promotion and the public's desperate desire to own the next rapidly expanding franchise, the shares were bid up to valuations that defied all rational logic, trading at astronomical multiples of their meager earnings. The founders and underwriters reaped massive windfalls, while the public was left holding equity in an over-leveraged, highly vulnerable business. Within a remarkably short period, the euphoria evaporated, the underlying business stumbled, and the enterprise plunged into bankruptcy. The shares, once hoarded at premium prices, were ultimately deemed entirely worthless. These four distinct tragedies, the decaying giant, the debt-fueled conglomerate, the aggressive corporate raider, and the overhyped initial offering, share a common, fatal thread. In every instance, the investing public willingly abandoned the strict mathematical discipline of the margin of safety, choosing instead to trust in historical legacy, financial alchemy, or promotional hype. Commentary on Chapter 17. History does not merely repeat itself in the financial markets, it plagiarizes itself relentlessly. While the specific corporate names fade into the archives, the exact same structural flaws and psychological delusions are resurrected in every subsequent economic cycle. Wall Street constantly invents new terminology to describe old scams, making the timeless lessons of Penn Central, LTV, and AAA Enterprises profoundly relevant to the modern allocator. The modern Penn Central, too big to fail. The catastrophic implosion of the Penn Central Railroad finds its modern equivalent in the 2008 collapse of massive financial institutions like Lehman Brothers or the bankruptcy of General Motors. Just as the public assumed Penn Central's sheer size made it immortal, modern investors believed the vast real estate portfolios and complex derivatives of the megabanks rendered them immune to failure. Yet, just like the railroad, the balance sheets of these modern titans were flashing, glaring warnings of extreme leverage and deteriorating asset quality. The intelligent mind must remember that a massive, historical franchise is entirely worthless if the liability side of the balance sheet is allowed to metastasize unchecked. The modern conglomerate, roll-ups, and financial engineering. The debt-fueled empire-building of LTV perfectly mirrors the modern roll-up strategy deployed by aggressive corporate management teams and private equity firms. Consider the spectacular rise and subsequent collapse of companies like Valeant Pharmaceuticals in the 2010s. The strategy was identical: use massive amounts of debt to acquire smaller competitors, slash their research budgets to manufacture an immediate spike in cash flow, and rely on Wall Street to reward the artificial growth with a higher stock multiple. The inevitable conclusion is always the same. Eventually, the company runs out of targets to acquire, the underlying business begins to decay from lack of investment, and the massive debt wall crushes the enterprise. The modern allocator must fiercely reject any business model that relies on endless acquisitions to mask a lack of organic internal growth. The modern NVF, the LBO, and junk debt. The absurdity of NVF using junk debt to acquire a larger company is the direct ancestor of the modern leveraged buyout, LBO, boom. Today, highly aggressive entities routinely acquire massive mature businesses by saddling the acquired company with billions of dollars in high-yield debt. While this financial engineering can generate spectacular returns for the insiders if conditions remain perfect, it leaves the underlying business dangerously fragile. When an economic contraction arrives, the cash flow that was supposed to be used for innovation and survival is entirely consumed by interest payments. The defensive investor must completely avoid the common equities of companies that have been subjected to heavy, debt-laden reorganizations. The modern AAA enterprises, SPACs, and profitless tech. The feverish, logic-defying initial public offering of AAA Enterprises was perfectly reincarnated during the Special Purpose Acquisition Company, SPAC, boom of 2020 and 2021. In a period of maximum market euphoria, hundreds of blank check companies raised billions of dollars from the public to merge with unproven, highly speculative startups, ranging from electric vehicle concepts to space tourism ventures. Many of these companies possessed zero actual revenue, yet were assigned multi-billion-dollar valuations based entirely on futuristic, wildly optimistic projections. The public, terrified of missing out on the next revolutionary technology, blindly threw their capital into these vehicles. As the inevitable laws of financial gravity reasserted themselves, the vast majority of these heavily hyped entities lost 80% to 90% of their value, incinerating the wealth of the retail public, while the original sponsors walked away unscathed. The ultimate defense against becoming the victim of the next great case history is a rigid adherence to the mathematical realities of the balance sheet. When you demand a history of stable earnings, a fortress of liquid assets, and a rational price-to-earnings multiple, you permanently immunize yourself against the diseases of hype, aggressive accounting, and speculative mania. Chapter 18. A comparison of 8 pairs of companies. To further cement the principles of rational allocation and expose the frequently absurd pricing mechanisms of the stock exchange, we must subject the market to a rigorous, comparative stress test. By placing 8 distinct pairs of corporate entities side by side, matching a celebrated, high-flying glamour stock against a neglected, unfashionable peer within the same general industry, the stark disconnect between underlying economic reality and manic market perception is brilliantly illuminated. This exercise is not a parlor trick of hindsight, but a standardized analytical tool designed to force the investor to confront the actual mathematical cost of future expectations. In examining these pairings, such as the dizzying heights of real estate equities contrasted with the grounded reality of realty equities, or the astronomical premium demanded for American hospital supply versus the sober valuation of American home products, a distinct recurring pattern emerges. The market darling is invariably priced for absolute, unbroken perfection. Its price-to-earnings multiple is stretched to an exorbitant 50 or 60 times current profits, and its market capitalization floats untethered, often 5 to 10 times above its tangible book value. The buyer of such an equity is surrendering a massive premium for the mere promise of rapid, exponential expansion. They are paying for a future that has not yet occurred, leaving zero margin for error if the company stumbles or the macroeconomic weather sours. Conversely, the neglected stepchild in each pairing is priced as if it has no future whatsoever. These unglamorous enterprises, often possessing vast physical assets, decades of unbroken dividend payments, and formidable balance sheets, are traded at single-digit multiples of their earnings and frequently languish at or below their tangible book value. The market, hypnotized by the thrilling narrative of the glamour stock, completely ignores the robust, cash-generating reality of the boring competitor. Consider the classic juxtaposition of a highly promoted technological franchise against a massive, entrenched industrial supplier. The technological firm boasts a spectacular recent growth rate, but it is financed by heavy debt and its dividend is virtually non-existent. The industrial supplier, while growing at a plodding, unspectacular pace, generates massive free cash flow, possesses an impregnable fortress of a balance sheet, and returns a generous dividend yield to its owners. Yet, the stock market assigns the fragile, debt-laden technology firm a valuation that dwarfs the industrial giant. The intelligent allocator recognizes this as a profound, structural mispricing. The defining lesson drawn from these 8-paired comparisons is the terrifying vulnerability of the high multiple equity. When the inevitable economic contraction arrives, or when the glamour company simply fails to meet the market's impossible expectations for a single quarter, the destruction of capital is swift and absolute. The multiple violently compresses and the stock price collapses, even if the underlying business remains profitable. The premium paid for hope simply evaporates. The buyer of the unloved, undervalued peer, however, possesses the ultimate financial armor, the margin of safety. Because they paid almost nothing for future growth, their capital is protected by the sheer physical value of the enterprise's assets and its steady stream of dividend income. They are not reliant upon the market's continued euphoria. They rely solely upon the sober mathematical reality of the balance sheet. In the unforgiving arena of the financial markets, the disciplined acquisition of tangible value consistently and decisively triumphs over the speculative pursuit of glamorous illusions. Commentary on Chapter 18. The paired comparison remains one of the most devastatingly effective intellectual exercises in the defensive investor's toolkit. It serves as a necessary bucket of cold water whenever the allocator feels the seductive biological urge to abandon their discipline and chase a soaring momentum stock. The stock market is a master illusionist utilizing the halo effect to trick the human mind. When a stock price is rising rapidly, the public automatically assumes the underlying business is flawless, its management team is composed of visionaries, and its future is unassailable. Conversely, when a stock price is declining, the public assumes the business is fundamentally broken and its leadership is incompetent. By forcing a side-by-side, strictly mathematical comparison between a market darling and a discarded peer, the intelligent mind shatters this halo effect. To execute this strategy in the modern era, the investor must rigorously apply a standardized checklist to both companies, stripping away all corporate promotion and media narratives. The price of admission. What is the price-to-earnings PE ratio? Are you paying 80 times earnings for the darling, while the competitor trades at 12 times earnings? To justify an 80 PE, the darling must effectively conquer the world. The anchor of reality. What is the price-to-book PB ratio? How much are you paying for the actual physical assets of the business versus the intangible goodwill and future hopes? The debt burden. Does the fast-growing company rely heavily on borrowed money to fuel its expansion? In a rising interest rate environment, heavy debt transforms a brilliant growth story into a suffocating nightmare. The dividend reality. Is the company returning actual tangible cash to its owners, or is it hoarding capital while forcing you to rely entirely on the stock price going up? Let us imagine a modern pairing. A revolutionary, highly publicized electric vehicle manufacturer, the glamour stock, versus an entrenched century-old legacy automaker, the value stock. During periods of intense market euphoria, the electric vehicle startup, despite producing only a fraction of the vehicles and generating minimal profits, might be assigned a market capitalization larger than the entire legacy auto industry combined. The legacy automaker, despite generating billions in free cash flow and paying a massive dividend, is priced for imminent extinction. The speculator buys the startup, paying a massive ransom for a perfect, frictionless future. The intelligent allocator buys the legacy automaker, acquiring massive factories, global distribution networks, and immediate cash flow at a severe discount. When the startup inevitably encounters manufacturing delays or supply chain realities, its stock price suffers a catastrophic, wealth-destroying plunge. The legacy automaker, priced so low that it has virtually no expectations to miss, continues to churn out dividends and eventually executes a modest pivot to new technologies, resulting in a steady, upward revaluation of its deeply discounted shares. The ultimate takeaway is that you do not need to discover the most exciting company in the world to achieve exceptional returns. You simply need to find a fundamentally sound, terribly boring company that the stock market has irrationally priced for disaster. Chapter 19. Shareholders and Managements. Dividend Policy. The relationship between the legal owners of a public corporation, the shareholders, and the individuals hired to operate it, the management, represents one of the most profound behavioral paradoxes in the financial ecosystem. In any private, unlisted commercial enterprise, the hierarchy is absolute and undeniable. The owners dictate the overarching policy, evaluate the performance of the hired operators, and swiftly terminate those who fail to deliver adequate returns. Yet, when a business is listed upon the public exchange and its ownership is fractured among thousands of individuals, a strange psychological inversion occurs. The legal owners suddenly adopt the posture of docile, powerless subjects, while the hired executives assume the absolute authority of monarchs. The public shareholder routinely rubber stamps every managerial directive, blindly approves exorbitant compensation packages, and accepts years of mediocre financial results with nothing more than a quiet grumble before selling their shares in defeat. The intelligent allocator must absolutely reject this sheep-like submission and reclaim the sovereign mindset of a true business owner. The primary battlefield upon which this conflict of interest plays out is the corporate dividend policy. The generation of profit is the fundamental purpose of the enterprise, but the fierce debate centers upon who is best equipped to deploy that capital. Management possesses a natural, deep-seated, and entirely self-serving bias toward the retention of earnings. A massive reservoir of hoarded cash insulates the executives from the unforgiving realities of the credit markets, provides a vast war chest for thrilling and frequently disastrous corporate acquisitions, and physically swells the size of the empire over which they preside, which conveniently serves as the primary justification for increasing their own salaries. Management will perpetually argue that retaining capital allows them to reinvest in the business, theoretically generating greater future wealth for the shareholder. The defensive investor must subject this managerial optimism to a ruthless mathematical interrogation. The burden of proof rests entirely upon the corporate leadership. If management insists upon retaining the owner's profits, they must definitively prove that they can compound that capital at a rate of return significantly higher than what the average shareholder could achieve by receiving the dividend and investing it elsewhere. Furthermore, the stock market must validate this retained capital by demonstrating that for every dollar of profit withheld from the owners, the market value of the shares increases by at least $1. If an enterprise retains vast sums of cash for a decade, yet its earnings fail to expand and its stock price languishes, the management is guilty of a massive silent destruction of wealth. In such instances, the executives have forfeited their right to retain capital and must be compelled to distribute the profits to the rightful owners. The historical reluctance of shareholders to demand generous dividends frequently stems from a misunderstanding of taxation and a mesmerizing illusion created by stock dividends and stock splits. A stock split, the exchange of one high-priced share for two lower-priced shares, alters the underlying economic reality of the business not one iota. It is a mere paper-shuffling exercise equivalent to cutting a pizza into 8 slices instead of 4. You possess more pieces but not a single ounce more of actual nourishment. The public's irrational enthusiasm for stock splits frequently allows management to mask a stagnant cash dividend policy behind the illusion of distributed wealth. To operate as an intelligent owner, the allocator must recognize their absolute right to demand competence. If a corporation's historical returns on invested capital are consistently inferior to its industrial peers, or if the market price chronically fails to reflect the underlying asset value, the management has objectively failed. In these scenarios, the investor must shake off their apathy. They must scrutinize the annual proxy statements, vote their shares with aggressive independence, and enthusiastically support independent groups seeking to challenge entrenched, underperforming leadership. The financial markets will only function with true efficiency when the absentee landlords of American industry finally awake from their slumber and demand that their hired caretakers act with absolute fiduciary integrity. Commentary on Chapter 19. In the modern financial landscape, the epic struggle between the shareholder and the executive suite has evolved from the traditional battleground of the cash dividend into the opaque, highly manipulated arena of the share repurchase program, commonly known as the stock buyback. While Graham championed the cash dividend as the ultimate undeniable proof of a company's financial health and the primary mechanism for returning wealth to owners, modern corporate executives vastly prefer the buyback. In a pristine, theoretical vacuum, a share repurchase is mathematically identical to a dividend, but vastly superior due to tax efficiency. By utilizing corporate cash to buy and retire outstanding shares on the open market, the company reduces the total number of shares in circulation. This means the remaining owners possess a mathematically larger, more concentrated slice of the corporate pie, deferring any tax liability until they eventually decide to sell their appreciated shares. However, we do not invest in a theoretical vacuum. We invest in an arena governed by human greed and misaligned incentives. The modern execution of the corporate buyback frequently represents a catastrophic betrayal of the public shareholder. First, executives are routinely compensated based upon metrics like earnings per share, EPS. By aggressively buying back stock, management forcefully shrinks the denominator, the number of shares, miraculously inflating the EPS even if the company's actual net income, the numerator, is completely stagnant or actively decaying. This allows executives to trigger massive personal bonuses by engineering an accounting illusion rather than actually improving the underlying commercial enterprise. Second, the timing of these repurchases is historically atrocious. Because management teams are swept up in the same euphoria as the broader public, they routinely deploy billions of dollars of shareholder cash to buy back stock at absolute market peaks, paying exorbitant premiums. When the market inevitably crashes, the buybacks abruptly cease, precisely when the shares are genuinely undervalued and repurchases would be mathematically brilliant. Buying a dollar bill for $2 is a destruction of wealth regardless of whether it is done by an amateur speculator or a highly compensated chief executive officer. Most insidiously, massive buyback programs are frequently deployed merely to mask the silent, continuous dilution caused by executive stock options. Management grants themselves millions of newly minted shares and then uses the owner's cash to buy equivalent shares on the open market to prevent the total share count from rising. This is not a return of capital to the shareholder, it is a circular mechanism designed to seamlessly transfer the wealth of the enterprise directly into the pockets of the insiders, utilizing the public's money to hide the theft. The modern intelligent investor must read the corporate proxy statement with the intensity of an auditor. They must demand a dividend as a structural, cash-based anchor that management cannot easily manipulate. If an enterprise claims to be rewarding shareholders through buybacks, the allocator must relentlessly verify that the total outstanding share count is actually declining year over year and that the repurchases are being executed at rational valuations deeply below intrinsic value. Furthermore, the concentration of modern wealth within massive index funds has drastically altered the balance of power. The giant asset management firms now hold the deciding votes for nearly every major corporation. The individual investor must ensure that the institutions managing their passive index funds are not simply acting as rubber stamps for entrenched management, but are actively utilizing their immense voting power to demand rigorous capital allocation, combat exorbitant executive compensation, and ruthlessly fire underperforming leadership. The ultimate lesson remains unchanged from Graham's era. An equity is not a mere electronic ticker symbol. It is an ownership stake in a living, breathing business. If you refuse to think and act like an owner, you guarantee that you will be treated like a victim. Chapter 20. Margin of safety as the central concept of investment. If one were compelled to distill the entire sweeping philosophy of sound investment into a single irreducible concept, it could be articulated in 3 words: margin of safety. This principle is the silent structural bedrock upon which all enduring financial fortresses are constructed. It is the thread that unites the analysis of sovereign debt with the valuation of common equities, serving as the ultimate unforgiving touchstone that separates the true investor from the gambler. In the realm of fixed income securities, the margin of safety is easily quantified. When a conservative allocator evaluates a corporate bond, they demand that the enterprise's historical earnings surpass its required interest payments by a massive multiple. This excess earning power is the margin of safety. It guarantees that even if the macroeconomic weather turns violently hostile, or the company suffers a severe operational contraction, the bondholder will still receive their stipulated interest. The investor does not need to perfectly predict the corporation's future. They merely need to ensure the financial cushion is thick enough to absorb inevitable, unforeseen shocks. When transitioning to the realm of common equities, the application of the margin of safety becomes slightly more complex, but no less absolute. For the defensive investor, the margin is found when the anticipated earning power of the stock, the earnings yield, significantly exceeds the prevailing interest rate of premium bonds. If an equity offers an earnings yield of 9%, while prime bonds yield merely 4%, the 5% differential constitutes the margin of safety. This surplus yield, gradually accumulated over a decade, provides a formidable buffer against future declines in the stock's market quotation. However, the most mathematically pure, irrefutable margin of safety is discovered when an enterprise is acquired for significantly less than its appraised intrinsic value. When the market, in a fit of irrational despair, prices a corporation at merely 2/3 or 1/2 of its net tangible assets, the buyer possesses a massive built-in advantage. They are not reliant upon a sudden surge in corporate profitability or an ecstatic bull market to realize a satisfactory return. The sheer physical value of the assets protects the capital against all but the most catastrophic managerial blunders. The concept of the margin of safety is inextricably tethered to the principle of broad diversification. They are the twin pillars of portfolio architecture. Even the most meticulously calculated margin of safety only tilts the probabilities in the investor's favor. It does not offer absolute, divine certainty. An individual, deeply undervalued enterprise might still succumb to an unpredictable technological shift or a catastrophic, hidden liability. However, when the allocator systematically applies the margin of safety across a diversified basket of 20 or 30 distinct equities, the mathematical certainty of aggregate success becomes virtually absolute. The gains of the resilient majority will effortlessly absorb and overwhelm the losses of the isolated failures. Ultimately, the margin of safety serves as the definitive boundary line between investment and speculation. The speculator pays a premium for the thrilling, ephemeral promise of future growth. If their optimistic forecast proves even slightly inaccurate, they have no mathematical protection, and their capital is destroyed. The true investor, conversely, refuses to pay for future promises. They demand a price that is justified entirely by the sober, present-day reality of the balance sheet, ensuring that even if the future proves to be a profound disappointment, their principal remains secure. Commentary on Chapter 20. The profound genius of Benjamin Graham's final chapter lies in its radical humility. The demand for a margin of safety is an explicit structural admission that you are not perfectly clairvoyant. It is a mathematical confession that your analysis might be flawed, that management might lie, that inflation might surge, or that a black swan macroeconomic catastrophe might materialize out of a clear blue sky. The modern financial industry, armed with supercomputers and instantaneous global data, attempts to convince the public that risk can be entirely eliminated through complex forecasting models. Yet the persistent recurrence of devastating financial crises proves that the future remains permanently veiled. Because we cannot predict the future, we must construct portfolios that can survive the unpredictable. The modern application of the margin of safety extends deeply into the psychology of the allocator. It is not merely a shield against the erratic behavior of the stock market, it is a shield against the destructive impulses of your own mind. Protection against overpayment. When you refuse to buy an equity unless it trades at a 20 or 30% discount to its rigorously calculated intrinsic value, you permanently immunize yourself against the intoxicating hype of bull markets. You will frequently be too early to sell, and you will agonizingly miss out on the final euphoric stages of speculative bubbles. But you will also completely sidestep the devastating, wealth-eradicating crashes that inevitably follow. Protection against bad luck. A magnificent business can suffer a factory fire, a sudden regulatory crackdown, or a devastating cyber attack. If you paid 50 times earnings for that enterprise, such an event is a fatal blow to your portfolio. If you paid 10 times earnings, the event is merely a temporary, survivable setback. The margin of safety absorbs the impact of misfortune. The sleep well at night factor. The ultimate value of the margin of safety is psychological endurance. When the market inevitably plunges by 30%, the speculator is paralyzed by terror and routinely liquidates their holdings at the exact worst moment. The intelligent investor, knowing their portfolio was acquired at deeply rational valuations and fortified by cash-generating assets, views the panic with sovereign detachment, completely free from the agony of financial ruin. To navigate the modern financial ecosystem is to navigate a sea of constant, deafening noise. The talking heads on financial television will endlessly debate macroeconomic policies, the trajectory of interest rates, and the next revolutionary technological trend. The intelligent allocator ignores the noise and focuses entirely on the math. They ask only one question before deploying capital: does this price offer me a substantial margin of safety? If the answer is no, they calmly walk away. By mastering this single unyielding concept, you transform yourself from a victim of the financial markets into a master of your own financial destiny. This concludes the comprehensive summary and modern commentary of Benjamin Graham's The Intelligent Investor.